Uh, Good morning, ladies and gentlemen. Welcome to the Cummins India Limited Q3FY24 earnings conference call. My name is Ashwath Ram, and I'm the Managing Director of Cummins India Limited. Joining me on the call today is Ajay Patil, Chief Financial Officer of Cummins India Limited. Thank you for joining us on this call today. We are happy to announce that Cummins India Limited recorded the highest quarterly revenue and profits during the quarter ended December 31, 2023. This was aided by strong domestic demand across various market segments. Now, I would like to share the financial results of Q3 FY24 with all of you. For the quarter ended December 31, 2023, with respect to the same quarter last year, our sales at rupees 2,502 crores are higher by 17% compared to rupees 2,144 crores recorded in the same quarter last year. Domestic sales at rupees 2,177 crore are higher by 36%. Exports at 325 crores are lower by 40%. Profit before tax at rupees 602 crores is higher by 26% compared to the same quarter last year. This is a new record.
Ladies and gentlemen, the line for the management has been disconnected. Kindly stay connected while we try to reconnect them. Ladies and gentlemen, the line for the management has been reconnected. Over to you, sir.
Thank you again. Sorry for the interruption. I will repeat what I was saying. For the quarter ended December 31, 2023, with respect to the last quarter, our sales at rupees 2,502 crore are higher by 34% compared to rupees 1,871 crore recorded in the last quarter. Domestic sales at rupees 2,177 crore are higher by 60%. Exports at rupees 325 crore are lower by 36%. Profit before tax at rupees 602 crore is higher by 41% compared to the previous quarter. Segment-wise breakup for the quarter ended December 31, 2023. The sales breakup segment-wise is as follows. Domestic sales. Power generation domestic sales were rupees 1,073 crore, 51% higher compared to last year and 121% higher compared to last quarter. Distribution business sales were rupees 662 crores, 26% higher compared to last year and 21% higher compared to last quarter. Industrial domestic business sales were rupees 412 crore, 20% higher compared to last year and 37% higher compared to the last quarter. Exports. High horsepower exports were rupees 138 crore.
Ladies and gentlemen, the line for the management has been disconnected. Kindly stay connected while I try to reconnect them. Ladies and gentlemen, thank you for patiently holding. The line for the management has been reconnected. Over to you, sir.
Hi again. Sorry for this inconvenience. Don't know, some technical glitches, I suppose. I will restate some of these numbers. Exports, high horsepower exports were 138 crores, 38% lower compared to last year, and 48% lower compared to last quarter. Low horsepower exports were 147 crores, 44% lower compared to last year, and 30% lower compared to last quarter. As far as Cummins India financial guidance is concerned, regarding the sales outlook for the full year 2023-24, we continue to expect double-digit growth over the fiscal year 2022-23. I now open the session for questions. Thank you.
Thank you very much, sir. We will now begin the question and answer session. Anyone who wishes to ask questions may press star and one on the touchtone phone. If you wish to withdraw yourself from the question queue, you may press star and two. Participants are requested to use only handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Ravi Swaminathan from Avendus Spark. Please go ahead.
Hi, sir. Good morning. Congrats on a very good set of numbers. My first question is with respect to the power gen business. Both from a quarterly side and from a 9-month side, if you can let us know what was the kind of volume growth that was there in the power gen business, how much of the mix was CPCB 4 norm engines, how much of it was CPCB 2, and the realization gain also. If you can give a breakup on that, it will be great.
Sir, kindly stay connected. I'll try to reconnect him.
Yeah, sure.
Mr. Swaminathan, I would request you to kindly repeat your question, please.
Yes, sir. My question is with respect to the power gen business. If you can tell me both for quarterly and for 9 months, the volume growth that we had seen in the power gen business, the ratio of mix of CPCB 4 based engines and CPCB 2 based engines, and also the broad realization gain that we would have seen on the back of price increases related to CPCB 4 and general price increases.
Yeah, so I'll start off by saying, talk about CPCB 4 Plus. CPCB 4 Plus, as you know, the full implementation is only going to happen by June of this year. And so we have been selling CPCB 4 Plus products in some limited markets, markets where the regulation is already being implemented. And we have so far sold little over 3,000 gensets in those markets, and they are doing very well. They are at slightly better realization than the CPCB 2 gensets. But it's very difficult to predict the exact difference between what will happen when full implementation happens versus when the product has had time for us to mature and bring down costs and all of those kinds of things, whereas the CPCB 2 product is a fully matured product. And as far as the growth for power generation versus the previous year, we have grown the power generation market by 29%.
That is on the revenue side, sir. Volume-wise, how much it would have been?
Volume-wise is roughly proportional, It's pretty complicated to answer that question because the mix is very, very sophisticated as far as Cummins India is concerned. But if you take out certain aspects of pricing, I would say in excess of 20% is the growth in volume.
Got it. And which key sectors would have driven this 20% growth, sir? Any particular
I would say the top 5 big sectors which have been growing rapidly for us this year have been data centers, commercial realty, residential realty, infrastructure, and manufacturing.
Understood. And exports, the sharp drop this quarter, is it likely to normalize back to, say, 450, 500 crore levels, or is there some kind of dispatch delay? Why exports have been weak this quarter? Any sense on that?
Yeah, so I've been indicating for the last few quarters that exports has been softening. I believe that we may have now bottomed out. It's been weakening in multiple regions around the world, so it's pretty uniform that all our big markets around the world, whether it be in Europe, in the Middle East, in Asia Pacific, in Latin America, pretty much across the board we have seen softening of demand. Also, in this quarter, typically it's a correction quarter, so people globally try to correct inventory in this. In some areas where there are backlogs, then people try to push out as much material as they can. But in areas where there are no supply problems, like in our products, they actually try to cut back on the inventory. So we believe things have bottomed out. And despite all these constraints, we should start seeing it pick back up. Now, exactly how much it will pick back up will be determined by how the global markets continue to pick up. And we have seen that China is not recovering at all. We have seen that Europe continues to remain weak. And with all these further turmoil of Red Sea crisis, etc., we are starting to face some more problems with supply chain, etc., especially parts which come from out of Europe into the country, or even parts that we export from India to Europe. The lead times, etc., have gone up pretty significantly.
Got it. And my last question is, now that FY24 is almost done, hardly we have a couple of months, so your outlook on FY25, what kind of growth at a company level should we expect, broadly, revenue growth, if you can?
Yeah, it's going to be same as what we have been indicating for the last couple of years. It is driven by our aspiration is to grow at 2x of the GDP at the minimum, and to continue to improve our profit margin by at least 100 basis points.
Got it, sir. Thanks a lot.
Thank you. We'll take the next question from the line of Parikshit Kandpal from HDFC Securities. Please go ahead.
Yeah, hi Ashwath. Congratulations on a great quarter, sir. Sir, this is the second quarter where we have almost clocked 37% gross margin. I remember your commentary last quarter, you had said that the margins may correct again to 32 to 34%, but we have been holding on. So just wanted to understand, first of all, was there any one-offs in the revenue this quarter, any large data centers deliveries, which could have led to economies of scale and expansion in margin? And whether these margins are not sustainable and you are building the profit margin improvement on current base now?
Yeah, so we had another quarter of the perfect trifecta, which I had spoken about even last time, which means we were able to hold on to the prices. We continued to get the benefit of commodities. We continued to be able to sustain the work on the cost reduction that we have been doing. We did get a positive impact from a big delivery to a big data center customer, which is lumpy and which which the delivery happened in the last quarter. We were expecting that delivery to be pushed out into Q1, but we were able to make the deliveries happen in the previous quarter itself. When all the variables are positive, that's why we have been able to sustain what we did in the previous quarter. I did not think that everything would go well. Looking forward, I would say that we've already started to see some of the commodities starting to get more expensive. So metals such as copper and CR iron have started to get more expensive. So the positive impact we got from a weaker commodity cycle, I think we will see a little bit of a reversal on that. And then if the mix continues to be lopsided towards domestic and we don't see a strong pickup in exports, we are still likely to have the same problem.
Okay. And so if you can quantify how much was the contribution from the data center order in this quarter?
I can't exactly quantify. All I can tell you is it was one of the biggest orders in the country. So you can make some of your estimates from that. I'll just like to add that data center orders are in that much. They're big, lumpy orders, and it's going to continue. The cycle is going to continue. So this is not the first of it, neither is it the last of it. We expect this segment to continue to do well for at least the next couple of years.
Okay. The second question is on one of our channel partners, Jackson, has set up a capacity for manufacturing power engines. So is it, I think, 24,500 per annum? So will it in any ways impact our supply chain, our sales, our distribution?
No, I mean, they are exclusive. They sell only Cummins products. So whatever capacities they set up only go to help us sell more products. So
they will continue to buy from you and go brand and sell it. So this capacity expansion is for that. That's
right. Their power generation business is 100% with Cummins.
Okay, and just the last questions are on this CPCB 4 Plus. I mean, last quarter the contribution was about 30% plus in the mix, the sales. So what was the contribution for the Q3 and for the 9 months, if you can help us with that?
So you're talking about CPCB 4?
Yeah, CPCB 4 Plus contribution, you had said last quarter was about 30% plus in Q2 FY24. So what was the contribution in this quarter from CPCB 4 Plus engines, and as a 9 month as a whole, what was the contribution? And did you get any help from pre-buying? Because again, now that third quarter is gone, so do you think any pre-buying happening in fourth quarter, or part of that has happened already in third quarter?
So let me first correct your statement. I did not say that CPCB 4 Plus contributed to 30%. CPCB 4 Plus was just launched in July, and at the same time, the CPCB also announced that they would allow the sale of CPCB 2 product all the way up to June of 2024, which is why the takeoff of CPCB 4 Plus was very, very, very slow coming out of the launch. Majority of our sales continue to happen in CPCB 2 Plus. We also did manage to sell roughly 3,000 gensets in the previous quarter in CPCB 4 Plus. I would say that contributes to less than 25% of our overall sales. We think that as we get closer to June, that means probably in the April to June quarter of this year is when we will start to see CPCB 2 demand start to die down and a pre-buy in CPCB 4 Plus start to happen.
Okay. Okay, sir. Thank you and wish you all the best. Thank you.
Thank you. We'll take the next question from the line of Renu Baid from IIFL Securities. Please go ahead.
Yeah, hi. Good morning, team, and congratulations for the strong performance. My first question is, so if you look at, I know gross margins is a combination of various elements here. But last quarter, we were alluding that given the cost structures and the mix that we see in the market, maybe a 34 to 35% range of gross margin should be sustainable as we go in the next fiscal year as well. Do you think this should be broadly achievable and is in line with the 100 basis guidance that you're giving, or the 100 basis further increase in margins, profit margins over fiscal 24 would be more of operating leverage driven?
I think this is what we would love to have, but like I said, it gets increasingly difficult to do as you move forward. And certainly, as I've mentioned in my earlier conversation, we continue to have in this quarter all the variables going positive for us as far as gross margin is concerned. We think we will start to see some of that go reverse. And we will continue to work hard to manage our costs, improve the mix, try to get more product out with better mix, so that we maintain the margins at this level and work on improving it. So the aspiration is certainly there to continue to work to improve the margins. The reality on the ground is that we will start to see some of these variables go negative as compared to where they are today. So I would continue to say that it is going to be our attempt to be in this range of profitability as we move forward.
Got it. And on the export side, while you had given a heads up that we should be prepared for a bumpy quarter ahead, which is the way it has turned out, how do we see the demand bottoming out from some of the key regions? If you can share geography-wise comments. And also, how has been the developments with respect to customizing some of the applications related to CPCB4 for the EU and the American markets?
Yeah, so when I look at all the markets, so if you look at, I'll go in sequence of those that have been worst impacted. So Europe is down 59%. Asia Pac is down 20%, Latin America is down 20%, Middle East is down 53%, Africa is down 41%, US is down 47%. So pretty much across the board, markets are down. When we look at the forecast coming in, typically what happens is people shut down for the Christmas quarter. They try to push out as much material as they can, and in some cases they correct the inventory. Then they come back 1 to 2 weeks into the year, and then they start figuring out how to push volume and how to get the next year to be successful. So far, we've started off a little bit slow at the beginning of the year, but early indications are that the demand is not going to be below what it was in the previous quarter. So that gives us a little bit of hope that things are bottomed out and things will start looking a little bit better moving forward. But systemically, if some of those global markets, especially the Middle East, etc., if some of these crises and turmoil does not go away, it's going to be difficult to just come out of this lower demand kind of scenario. But I think things have bottomed out, and things will start to pick up in the future.
Sure. And on some of the new launches that we were planning on the export front in the developed market?
Yeah, and that's continuing, and we continue to every month we will launch more products, and so a lot of discussions are going on with the global markets to try to figure out where is the biggest value add that India can do to help them grow market share, to grow the business. And that work is going to continue. And India will, when I look at it, if you look at it in a quarterly perspective, it looks like, okay, it's going to be incremental improvement. But when I look at it from a 2, 3, 5-year horizon, the situation looks very positive from an India perspective.
Got it. And related to this, last on the export front, while you were among the early ones to highlight that as the global ICE value chain consolidates, globally, India should be a key beneficiary, and that should also drive exports for CIL. Have we started to see any initial signs of green shoots or inquiries from global partners for the products, or it's still the conventional business which you think could drive in the medium term?
I would say in the power generation business, the short to medium term will be completely driven by internal combustion engines, and there is significant capacity underutilization in most regions around the world. So I don't see it as changing very, very dramatically, but we are pushing pretty aggressively. We have got customers visiting us continuously. We are showcasing our products. Our plants continue to be amongst the best plants in the world as far as the Cummins network is concerned. Recently, one of our plants won the award as the best manufacturing plant in the entire Cummins network. So all of those kinds of things are being done to continue the focus on India as the best low-cost base for Cummins products globally.
Got it. Much. I'll get back in the queue with a couple of more questions on the industrial segment. Thank you and best wishes, sir.
Thank you.
Thank you. The next question is from the line of Ankur Sharma from HDFC Life. Please go ahead.
Yeah. Hi, sir. Good morning. Thanks for your time as always. First on the power gen business, if you could talk about the CPCB4 engines, have the price hikes been taken, whatever was needed, has it been followed by your peers? Essentially trying to understand, has pricing kind of settled down, and therefore, as we move into, majority of engines being CPCB4 from say Q1, Q2 of next year, margins are largely intact or maybe get better.
I would say that we had the early lead in launching these products, but I think as of now, everybody in the market has also launched these products. Mm-hmm. It's difficult to predict whether the prices have stabilized because you're selling product from both the regimes. You're selling a CPCB2 product and you're selling a CPCB4 product into the same market. And so the people buying the CPCB4 product are the people who do not, the regulation mandates that you need to buy this kind of product. So it's price inelastic as of now. But moving forward, as the entire product goes to one regime, then you will get a truer picture of what competition is able to do versus what we are able to do from a pricing perspective, and we will get a clearer indication of whether margins can be held or competition is getting so intense that we have to reduce margins to hold on to or gain market share.
Okay. So still a complete pass-through has not happened, right? So essentially...
It's not. And you will not get that clearer picture till all the capacity is being utilized for a single product. Right now, as I said, less than 25% of our capacities are being utilized for CPCB4 products. So you don't have a real understanding of fully leveraged costs.
Right. But given the demand is very strong, I guess passing on pricing should be relatively easier, right? That's the basic assumption.
So we have been able to hold on to all the pricing that we have passed on in the market. Competition has also passed on increases in prices. The only area where we are feeling some pressure is we have some global competitors who are bringing in products through France and other countries and are then selling those products in India. So there is some competitive pressure from those competitors because they don't have the same margin expectations that we as a company have.
Fair. Okay. Secondly, on the industrial business, again, very strong growth, what you reported this quarter, but there's a little bit of a contrast versus some of, other industrial short cycle companies which are seeing a slowdown. So if you could just help us, which sector is really driving this? Are you starting to see any slowdown there pre-elections or, given your current order book in this, whatever, you have in terms of inquiries order book, your top line growth can remain strong next few quarters?
Yeah, so all I can say is that the results look good, but we are not so happy with where we are overall. What I'm trying to say here is that we are coming off a very low base. So when you come off a low base and you do well, the numbers look great, but it's not close to what our aspiration has been of where this market can be. The segments which have helped us positively have been construction, which has significantly underperformed the investment in infrastructure. So if you see, the infrastructure investment has been going on for the last 2 or 3 years, but the construction market has significantly underperformed that. So there has been a little bit of a catch-up in this quarter. Also, the compressor market, which is a highly cyclical market, which with almost 40 to 50% swings up and down, we got the positive swing on it in the previous quarter. And rail continued to hold on. So again, coming off a much lower base than what we were used to in the past. We did better than that lower base. And the other segment, which is that of mining, actually has underperformed what the potential is from an overall market perspective.
Okay. And just lastly, on distribution, also fairly strong growth here. So anything to flag off, what's really driving? Because distribution typically is more like a very steady state, 8-10% kind of a growth business. So what's driving this here?
Yeah, so I think I've spoken about this for the last few years. See, in 21 we set out with a very clear strategy that we need to grow the overall India business at 2x of the GDP, and we found out that some of these businesses, like the distribution businesses, historically had been growing at 6 to 8% and very steady doing that. What we found that we were underserving the markets. So there were many areas within distribution, within parts, within aftermarket, within service, where we were underserving the needs of our own customers. And as we focused on that, as we started improving our channel, improving the types of parts, improving the service offerings, we are finding that this business can also grow at that 2x of GDP and better levels. And because we were growing historically at a lower rate, there is a catch-up that has been happening for the last few years. And as of now, we are fairly confident that we can continue this growth cycle even in that business.
Okay, got that. Great. Thanks, and that's it.
Thank you. The next question is from the line of Amit Anwani from PL Capital. Please go ahead.
Yeah, thanks for taking my question. My questions are on the gross margin. You did alluded that many factors played a role on a positive side. But still want to understand, despite exports contributing lower this quarter, with respect to product mix, if you want to give some sense which segment products which are higher margin would have contributed last quarter and this quarter, and that is where the better gross margin which is coming in.
I think the high horsepower sales have been better, and so whenever high horsepower sales are better, margin improves. So I would say that is a more broader statement as far as margins, and also distribution volumes continue to remain strong, and aftermarket is typically at better pricing than general product sales. So the combination of those from a mix perspective is what was most positive.
Right. As you given a very strong commentary for the domestic market now, just wanted to understand what was the capacity utilization, any capex we are needing, any debottlenecking, any sense on this front?
We continue to remain at 60 to 70% of utilization of our capacities. So no major investment is planned other than balancing capacities. There are some special capacities that we put in so that we can do some more exports there is rebalancing and some critical special machines, etc. But nothing which will significantly take up capacity. We still feel we have plenty of headroom. I think we can double our sales and still not be at greater than 100% capacity utilization. We have that kind of inherent capacity built in.
So lastly, on the Red Sea issue, which you did highlighted that there could be an impact on supply chain and deliveries. I just wanted to understand. So obviously the export has been slightly muted, but any near-term assessment on Red Sea issue where we can see the deliveries not meeting or any shortfall of revenue which can happen? Any color on that?
Yes. So what has happened because of the Red Sea issue, as far as we are concerned, then ships are not going through the Suez Canal, and they're going all the way across the Horn of Africa. So that adds anywhere from 2 weeks to 4 weeks to the lead time. So everything that had been ordered is coming late. So for some of the export orders, some of our raw materials are coming in late. So some orders could get deferred by as much as couple of weeks out. The same is true with our delivery. So anything that we are shipping is reaching the ports of Europe 2 to 4 weeks later. And there is an increase in logistics cost, but that's a fractional increase. That's not enough to really talk about. But more of it is supply chain getting disrupted and lead times lengthening and complexities related to that. I think it's a shorter term issue. Once you reassess the supply chain, you feed in the new numbers and you place more orders to balance out the longer lead times. I think things will get back into control. So I expect by the next quarter we should have this issue pretty much under control.
Sure. So thanks for taking my questions. Thank you.
Thank you. The next question is from the line of Kunal Seth from B&K Securities. Please go ahead.
Yeah, hi sir. Thank you for the opportunity. Most of my questions have been answered. Just one clarification. Sir, you did mention, right, that the entire cost increase, the price required for passing on the cost for CPCB4 has not been taken yet.
What I think I'm trying to say, and let me, you can ask the question again if I'm not clear enough, is that right now the full advantage of a single system which is producing one type of product is not yet. So there is some of the cost of development, etc. The entire cost is absorbed on a much smaller volume of product. As we move forward, as the full utilization of the factories goes towards CPCB4, the cost base theoretically should absorb the costs in a better manner, and that should, in my view, help improve the margins of CPCB4 product.
Right, sir. So what essentially we were trying to get at is that you had indicated that the cost increase in CPCB4 machine is about, I think, 20-25% in terms of price increase. So has that kind of price increase in the 3,000 machines that you have sold, has that kind of price increase been absorbed by the market is what we're trying to understand.
As of now, like I said, because it is focused on very select markets, that price has been, customers are buying that product at that incremental price. But how that will be once it's sold in all markets and is something we have to still find out. We think the hypothesis that we have had cost increases, everyone also has had cost increases, is the hypothesis which we are testing in the market, and we think that will hold true. But it's a very competitive landscape, so you got to wait and see how the market plays out before you can make a comment like that.
Sure, sir. Got it. Appreciate it. Thank you so much.
Thank you. The next question is from the line of Rahul Kajare from Haitong Securities. Please go ahead.
Good morning, gentlemen, and thanks for the opportunity. While you've given a very good commentary in terms of qualitative aspects of how demand has played out during this particular quarter, can you please quantify the power gen, the breakup that you normally give in terms of high horsepower, medium, and so on?
Sure. So our high horsepower sale was 770 crores. Our heavy duty sales were 128 crores. Our mid-range sales were 132 crores, and our low horsepower sales were 43 crores.
Right. So my second question is on, we've seen employee costs has been on a rise. Now, is it fair to expect similar quarterly run rate of about 210 crore rupees for next year also?
Yeah. So, if you study the markets in India, the wage inflation is roughly between 10 to 12% annually, and we are seeing similar kind of wage inflation. In this financial year, we've also had the impact of one additional quarter of compensation. We changed the cycle of how we compensate our employees. So we think there is, it's slightly negatively impacted in this financial year, but we expect growth in our costs to be in the range I had indicated, just based on the market tendency in India to increase wage at that level.
Sure. So my last question is on, you've been talking about supply chain disruption, which was impacting growth, but with the kind of growth that we've seen, is it fair to say that supply chain disruption, if any, are completely behind now?
I will never make that statement, because every time I've made that statement, I've been bitten badly by something which goes wrong around the world. You can see already that Red Sea has already happened, and electronics, which we had been struggling with in the past, that problem is not fully behind us. I would say we are it's 90% behind us, but 10% is still a niggling worry, because China demand is down significantly, and so we are able to get our ask of some of these electronics. If that demand were to pick up, the global supply of these electronic components is still not up to mark, and we could still end up in some kind of supply challenges and trouble were some of those economies to pick up.
Sure, sir. Thank you very much for your commentary, and all the best.
Thank you. The next question is from the line of Mahesh Bendre from LIC Mutual Fund. Please go ahead.
Hi, sir. Thank you so much for the opportunity. Sir, in last 9 months at the consolidated level, we have reported EBITDA margins of 18.4%. And when we talk about the next year, you indicated that you plan to grow with, double the GDP growth rate and 100 basis improvement in the margins. So 18.4% should I take a benchmark where we plan to add 100 basis point above this for next year?
This year we have grown better than our own plan. So, it's difficult when you take that as the base, and then we need to grow another 100 basis point on that. But certainly that is always going to be our attempt. Aspirationally, that is what we want to do. But realistically, I would say to look at the look at a 3-year kind of average, and then use that as a base from which we will continue to aim to grow by at least 100 basis points.
Yeah, because the last 3-year average has been, it's around 16%. So.
Yeah, so I'm not going to answer beyond that. So, because it's very difficult to give you an answer like that. Aspirationally, we want to keep getting better from where we are. Realistically, all the variables don't play in our favor like they have played for us this year.
No, I'm just trying to understand. You said 100 basis point margin expansion. I just wanted to know the base on which you want to build on that.
Yeah, the base for us has been from our starting point in 2021. And so what we have said is that for the next 5 years, this is what is our ambition. And ambition is not equal to reality, right? So this has been our ambition, and this is what management is trying to strive to do.
Okay, but at least we'll be able to maintain this margin, 9-month margin for next year?
That is our attempt.
Okay, sure. Thank you so much, sir.
Thank you. The next question is from the line of Aditya Mongia from Kotak Securities. Please go ahead.
Thank you for the opportunity. I hope I'm audible to you all. First of all, congratulations on a very strong set of results. The first question that I had was more on this capacity utilization number that you are suggesting between 60 and 70%. As this mathematics serves me right, so probably a higher number of few quarters back. So have you guys kind of added capacity, or have you kind of meaningfully de-bottlenecked existing capacity? Some more color would be useful over here.
Yeah, so we continue to improve the efficiency of our lines, and if you look at how much exports has dropped, the similar kinds of lines are used for both domestic and export products. So we have not really expanded significant capacity, but yeah, certainly we have debottlenecked some of the lines to be able to produce even more than what we have produced in the past. So that's where we are, and we will continue to do that. We will continue to balance out, put in balancing equipment to make sure that the flows are better.
Understood. The second question that I had was more on exports. If I recall your commentary from the last quarter, you had started talking about Europe being the next kind of destination for us from the perspective of CPCB4. If more progress has happened, would be kind of useful to know. And also a related question on exports. As we've been hearing about the capacities of US plants being utilized for newer products such as, let's say, Fridley is doing the electrolyzers. Does that create an opportunity for our existing kind of products or new products to kind of do better in the near term beyond this CPCB4 being the driver? Thank you.
I'll answer the second question first. Certainly, it does create options, but what happens is, especially for North America, because of USMCA, some of those products are preferred to be moved into places like Mexico. But certainly for certain types of products where we have a cost advantage even after paying USMCA duties, I think certainly the opportunity exists for India to be able to supply more to those markets as well.
Understood. And maybe just a last question from my side. The distribution has been a fairly revealing kind of segment, and I kind of recall your remarks saying that for the next 5 years, it could be the fastest growing business segment for you. It would be useful if you can kind of bring down or break up the growth between what is happening from the perspective of, let's say, higher penetration versus what you were doing on the existing products. And then secondly, on new lines of business that have started to kind of show up well.
Yeah, so I would say all areas of distribution are doing relatively better. So part sales are doing better because penetration is better. We have introduced many new parts and products into parts. So you not only is our share of the older pie better, but we are changing the pie itself, making the pie bigger and targeting many more customers and many more types of products. So it's both as far as parts is concerned. As far as other services, we are offering longer warranties, better full service warranties, more assurances of guaranteed uptime. Customers are more sensitive now to downtime than they've ever been historically. So that presents an opportunity for a company like Cummins to be able to improve our share in that
service pie as well. And we are entering into newer areas. We are supporting customers in rail, in marine, in defense, in many of those niche kind of markets. Some of that work is done through the distribution business. The other area we are trying to grow, which is still, I would say, in infant stages, is the reconditioning market. If you look at mature markets like North America, nearly 25% of the sale in the aftermarket is from reconditioned parts, whereas in India it's much lower. And so we have good technology in reconditioning and remanufacturing. So we are trying to grow in that space as well. So it's a combination of all of these strategies, which is results. And I continue to hold to my statement that we do think there are multi-year opportunities to keep growing this business.
That's splendid, sir. And we can see that your margins growing better than that of peers at a faster pace. So all the very best, sir. Those are my questions.
Thank you. Thank you, sir. The next question is from the line of Mohit Kumar from ICICI Securities Limited. Please go ahead.
Yeah. Thanks for the opportunity, sir. So my question is, does the supply to data center doesn't get impacted by CPCB4, and does the data center revenues makes our quarterly revenues lumpy?
The answer one is CPCB4 is not applicable to those very, very large gensets. They fall under different provision. Above 1,000 kilowatt, the regulation is not applicable for CPCB4. Plus, there's a different regulation called stack emissions, which are applicable for those products. So it doesn't impact it. The second part of the question, sorry, could you repeat the second part of your question?
Does the data center revenues, because
the lumpy portion, yes,
lumpy in a particular quarter when the supply happens,
Yeah, because these are big installations, and so it's always going to be lumpy. So yeah, it's very difficult to predict. Sometimes there is the deliveries are sometimes pushed out a quarter. Infrastructure is not necessarily ready, so it does tend to be lumpy. Yes, the answer is yes.
My second question is it fair to say that whatever we are selling in the lower category, lower KVA category, which is selling right now and for next couple of quarters, the orders were booked prior to June 23. Proportion-wise, they are very significant.
Again, could you repeat that question? I was not clear what you meant by orders being booked before June 23. I didn't understand that question.
Because the CPCB4, ICS4, there was extension of CPCB4 from June 23 to June 24, and your purchase order has to be signed before June 23, if I'm not wrong, right? So my question was, does this proportion what we're selling right now, is it have a significant contribution to your top line, especially in power gen?
Yeah.
Will it continue? Will it continue to fit till the next couple of quarters?
Yes, I think it will continue for the next couple of quarters. So the transition to CPCB4 products is likely to happen only in the April to June quarter on a full basis. So CPCB2 is the primary contributor to our top line and bottom line as far as power gen is concerned.
Understood, sir. Thank you and all the best. Thank you.
Thank you. The next question is from the line of Lakshmi Narayanan from Tunga Investments. Please go ahead.
Yeah, thank you. A couple of questions. You talked about your mix in HHP, heavy duty, mid-range, and LHP. What's the market share you have in these segments as per your estimates?
We usually don't comment on exact market share numbers because we get the information from various sources and they are always slightly different. All I can comment is that we continue to hold market share on most areas, and we have gained a bit in some of our high horsepower areas.
Or let me put it this way, from a market potential point of view or the current market point of view, whether the market, like if you draw a pie chart of the HHP, HP, mid-range and LHP, how it will look like? So your revenue is 70%. What is the market's revenue?
Right. So you're talking about the market size in some of those.
Yeah.
Again, if I tell you what's my revenue and I give you the market size, then you have the market, market share. Right?
No. I mean, directionally, I just wanted to know whether HHP is like 50% of the market or 30% of the market or 70%.
No, as a matter of fact, some portions of low horsepower are probably the biggest markets in India, and we have a lower market share there. So the largest volume and value is in low horsepower, primarily because it goes into telecom and various other